All right, so let me go ahead and share my screen with y'all. All right, let's do it. Here we go. So thank you, ladies, so much for being here again. The second week of the Masters series class, called Generational Wealth Series for Women on how to leverage real estate to generate wealth. So last week we discussed the basics on investing. So we basically talked about equity, using equity as a leverage to use the money from anyone who are homeowners, or you can use equity to use that towards purchasing your next investment. We talked about those who are possibly currently renting to be more strategic when you are renting, meaning when you do rent, you don't want to just live in any neighborhood because um, you want to be in a neighborhood that is growing. You want to be in an affordable neighborhood to allow yourself to save money rather than all your money is just going to your bills. Because one of the things that lenders look at, they look at your reserves, which we talked about last week, Tuesday. So another thing too that we discussed, um, what else have we discussed? We talked a little bit. Someone asked about foreclosures, which if in the event that when we do get into that, you can still apply these methods to purchasing foreclosures. But tonight we're going to talk about financing like a strategist, the different types of loans that are available to you to purchase. There's not one cookie cutter type of loan. There are many different types of loans available to you, ladies, based on your scenarios. Some of us are W-2s, some of us are 1099s, some of us are self-employed where we get paid how we get paid and we just report it on our income. And you can actually use the deposits from your bank statements. So we're going to talk about all of those different types of loans available. And if you guys have any questions, feel free to ask in the group chat so I could come in and answer your questions. So let us go ahead and get started. So, okay, so as I mentioned, the title of the session is Financing Like a Strategist, Traditional to Private Capital. This is a comprehensive guide, ladies, on a spectrum of real estate financing from government-backed loans to private capital structures, whether you're scaling a rental portfolio, acquiring your first investment, or just restructuring your capital stock, understanding each financing tool is the difference between reacting to markets and leading them. Okay, so ladies, tonight is not about you getting a mortgage. That's, I guess, much later on in life, much later. But today, this is just all about you guys, you ladies, just learning and understanding what's available to all of you. Um, I'm trying to fix my screen so I could see you guys perfectly. Hold on one second. Just want to make sure you guys are good. Okay, not what I wanted. Hmm. Oh well, I'll just do it like this. All right, it's okay. I'll just do it like this. All right, so let's move on. All right, so understanding capital debt, debt as a tool. So most investors most investors think debt as a burden, something to minimize and eventually eliminate. Sophisticated real estate investors think about debt entirely different, as a precision or instrument for amplifying returns, preserving liquidity, and accelerating portfolio growth. The strategic deployment of borrowed capital is the cornerstone of nearly every major wealth story. So we're going to go over other people's money principles. So this allows investors to control far more real estate than they could ever with equity alone. So if you're someone who do not have a whole lot of reserves or savings, one of the fastest ways for you to generate your to find your down payment rather quickly is to use debt as a tool. So before we get into it, I'm just going to just give you a few key metrics or key terms, which is your loan to your LTV or loan to value. Your loan to value basically means it's a ratio of the loan amount of the to the property's value. So if your house, is valued at 500,000 $500,000, and then your purchase price is is actually, no, I'm saying it backwards, because then it's actually more than than 100% of your property is valued more. So let me use this example here. My apologies. So when you're using other people's money, I'm going to use this example here. So a 500,000 property purchase with 20% down. So that's $100,000 that appreciates at 10% yield, and it gives you a 50% return. So the LTV would be 80% because you're putting $100,000 down. So again, it's the loan amount to the appraised value that determines your LTV or your loan to value. Now, your debt service coverage ratio, which we're going to talk about. So put your finger on this term. That is the net operating income divided by the total debt service. So when they say net operating income, that means your mortgage, your insurance, your taxes and insurance, and in some cases your association. That is the operating income. And then the total debt service is the rent that's coming in, which we'll discuss. And for lenders, it has to be above 1.25, meaning, which we'll talk about in a little bit. And when you have that amount, 1.25, it basically means that you're always going to make your mortgage payment, and you're going to make a profit as well. Now, interest rate versus cost of capital. The true cost of debt includes your origination fees, your points and your prepayment penalties. Prepayment penalties is in the event that if you pay a mortgage off early, and it was stipulated when you bought the mortgage that you were supposed to keep it for whether it was 1 year, 2 years, or 3 years. If you should pay it off early, they usually penalize you for that. But in most cases, most people usually will, when they get a mortgage, they will ask to not have a prepayment penalties. So in the event that they want to refinance or sell the property, they won't get penalized. Origination fees, ladies, is the cost the compensation of the broker and the lender to do the loan, and your points is like interest rates. Amortization versus interest only. Interest only periods maximize monthly cash flow, meaning when you pay only on interest only, you're not paying anywhere towards the principal. And that's good if you are not planning on keeping the property long and you want to have a lot of cash flow. Last week, we talked about the long game and the short game. We talked about if you decide that you wanted to, we talked about if you wanted to have cash flow and you wanted like an additional source of income, getting a loan interest only is the way to go, because it keeps your payments extremely low because it's only paying towards your interest and nothing goes towards the principal. Where with amortization, that's the long game where it's actually paying towards your principal and the interest rate, but it's building towards your equity. So strategic investors, they match financing structure to hold the strategy, and then a fix and flip demands short-term bridge capital, which would be like an IO or interest only. 30-year buy and hold deserves a fixed interest rate, long-term amortization debt. So that means you're paying towards the principal. And if you mismatch if you mismatch them, it'll cost you greatly in this industry. So we're going to go on to the next slide. So now we're going to talk about the three different types of traditional loans. So you notice that I say traditional because these are the loans that are government backed. and then we're going to talk about non-traditional loans in a little bit. So as I mentioned, with these loans, these are government-backed and conventional loan programs, which remain the gold standard for affordability. So if you're someone who do not have the reserves to put down a hefty down payment on the other types of loans that we're going to talk about, and you want to an entryway into investing, this is the way to go. The rates are extremely competitive. It's a lot more accessible to anyone instead of in the loans that we're going to discuss. And with these types of loans, you guys can actually buy either 1 to 4 unit properties with these types of loans. And it's extremely important to understand how each of them works. So we're going to go ahead and start with FHA. So FHA loans are backed by Federal Housing Administration. And with FHA loans, you can put as little as 3.5% down, which is a favorite among buyers. Another thing that's a favorite among buyers is that you do not have to be in the 600s to get a loan. You can be, I put 580, but there's some lenders that will go as low as 550 and will go as low as 500 credit score in order to get financing. Now, when you get dip lower into like 500 or 550, they typically require you to put more of a down payment. So if you only have just 3.5% down, then your credit score would have to be at a 580. With these types of loans, you can purchase a duplex to a fourplex. We talked about last week that if you live in one and you rent the rest of the units, so your tenants will actually pay off your mortgage, and it allows you to free up your expenses for you to save to go on to the next property. So as the slide says, if you live in one and you rent the others, that rental income will offset your mortgage. Another thing that you should be aware of is mortgage insurance premiums. Mortgage insurance premiums is insurance for the loan in the event that it defaults. It protects the lender in the event that you default on the loan and the property goes into foreclosure. For MIP or mortgage insurance, you pay that for the life of the loan, as long as you're paying less than 10%. Now, if you end up paying 10% or more or 15%, you don't have to pay MIP. Now we're going to move on to conventional loans. Conventional loans are backed by Fannie Mae or Freddie Mac. They too offer you as little as 3% for primary residences, and for investments, you would have to put 15 to 25% down. Now, with conventional loans, they also have mortgage insurance called private mortgage insurance. And if you put anything below 20% down, you have to pay for that until you've paid 20% into the loan, where it eventually gets removed. With conventional financing, which is a really cool part, is if you're allowed to have 10 financed properties simultaneously together under conventional loan financing. Meaning you buy a house, you buy a house and you said, oh my God, I see this duplex across the street from me. I need to buy it. I must have it. And they'll let you buy that one. No problem. As long as you meet their guidelines and you have the down payment to pay it, you are allowed to do that. And then you found 4 more properties that are available for sale. And you're like, oh my God, I gotta get it. And you end up taking the equity out of the first house you was living in, the second house that you were living in, to buy those additional 4 houses. You can do that. And that's a cool thing about conventional financing. With conventional financing, your credit score needs to be at a minimum 620 to get financing. Now, if you have higher credit scores in the 680 or above, that's actually great, because the higher your credit score, the better terms that you will have and interest rates that you will have with the lender. Now, my favorite, my favorite, VA loans. VA loans are available exclusive to eligible veterans, active duty service members, and surviving spouses. Is anybody a vet or a surviving spouse of a veteran? Anybody?
No.
No? No? Okay. And that's okay. So with VA loans, if you guys should ever, I don't know, marry or I don't know, your kids go to the military and they end up becoming um they honorably discharged and they end up wanting to co-sign with you. VA loans are great loans because they offer 0% financing. There's no private mortgage insurance, and the rates are extremely, extremely competitive. Their terms are actually better than FHA loans. Like VA loans, they do everything for veterans. The reason why I say that with VA loans, let's say you decide you wanted to buy a condo or a townhome under the FHA loans, that property the HOA has to be FHA approved. If it's not FHA approved, you can't get an FHA loan on a condo or a townhouse. And I'll give you an example. There's a complex called Quatrain in Ives Dairy. I was trying to help this nice lady, this really nice lady, refinance her house because they're going through their 40-year recertification. The 40-year recertification is a result of the collapse of Surfside Towers. And so every single community that's over 40 years old has to go through a recertification where they have to do structural recertification, electrical, firework, their balconies, their windows, everything, the driveway, the garage, everything you could think of, they have to do it. And this is a very expensive process, and it takes a lot, it takes many years to accomplish. So anyway, I say that to say with this particular complex, they're not FHA approved because they're going through so many so they are going through so many not I don't want to say legal challenges, but they're going through so many inspections. They have so many challenges, even though the money is they have money for reserves, but it's just too many violations that are going on that FHA is like, no, we pass, we don't want to do this. Where VA loans, they will do a spot approval, and if they have the enough information that satisfy them to give you a loan, they'll approve that complex right then and there, where FHA would just flat out deny that complex. So VA loans are really great loans for VA for veterans. If you have a family member or a friend who is a vet and has not used their their entitlement, you should encourage them to do that because they are allowed to purchase multi-units up to 4 units where they can live in one and rent out the others. And in some cases, there is a funding fee that if you, let's say you're disabled, you're actually exempt from that funding fee that is financed into the loan. So these are three of the most popular loans right now for affordability. If you cannot afford to put 15% or more, 15 to 25% down on your down payment, these are your best bet. Each of these programs do have their occupancy requirements. They do have a loan limit that's tied to the county. Every county has a loan limit. And they are, except for VA loans, they adhere to the debt to income ratio. Last week, I explained that your debt to income ratio is the amount of debt coming out, your liabilities, your bills, like your credit card bills, your car note, versus your can you make the screen bigger? Huh, let me see. Are you looking at this through your phone, Bev? Let me see. Is that better?
Much, yeah, my iPad.
Oh, okay. Let me see.
Yeah,
No,
that's better. I can see
no,
the,
no, no. It's bleeding.
that's a little bit too big, but
Yeah,
yeah,
it's
that's
too
better
big.
than before.
Okay, perfect. Okay, great. So yeah, so like I was saying, debt to income ratio is the debt going out versus the income coming in, and it needs to be typically between 43 and 50%. I will tell you a hack. They really don't want you to be at 50%. They really want you to be at 47 to 48%. So even though they say 50, they really want you at 47%. That's really their threshold. That's what I've seen. My experience in the last couple of loans, they prefer 47% as as pushing it as to the limit. So now we're going to go to non-QM loans and bank statement loans. So as I had mentioned before, I was talking to you guys about traditional loans, which is VA loans, conventional loans, FHA loans. Now we're going to talk about non-traditional loans, which is called non-QM loans. Non-QM stands for non-qualified mortgage. These types of loans are for investors who don't have a clean W-2. That's for someone like myself, someone who's self-employed, someone like myself, and possibly Bev, and business owners and investors with very, very complex tax returns. I do taxes too, so I've seen some really, really complicated taxes that these types of loans are the way for these types of investors. When it comes to these types of loans, they are subject to paying a higher down payment. They typically have higher interest rates than what you would have on your FHA and your conventional loans because they're not subject to the government. They're not subject to Fannie Mae. So let's take a look at your different types of non-QM loans or non-qualified loans. So we're going to first start with your bank statement programs. These types of loans, they don't look at your W-2s, they just look strictly at your bank statement. They will use as little as 12 months to 24 months of your personal or your bank statement, not both. It's one or the other to calculate your qualifying income. If you are using your business account, they're going to take 50% of it towards your liabilities, like your bills, because they're going to comb through it. They're going to look through every single line item in your bank statement, and they're going to take account to all of those charges that you are paying for. If you're paying for gas or equipment, you're paying for supplies, they're going to take that into account. One thing that you should know about that I didn't put in the slide, they also look at your non-sufficient fund fees. So some lenders are very stringent about NSF fees, like your negatives, that $35 that they charge you for not having the money in your account on time. Some of them are very stringent that some of them will only allow you to just have a couple or a handful, and some of them don't want you to have that at all because they feel like, well, if you don't have the money on time to pay something little, how do we know you're going to have the money on time to pay the mortgage? So you want to be really careful with your spending to so you avoid NSFs or non-sufficient funds. The next type of non-QM loan is your asset depletion. These are people who have a lot of liquid. However, they don't have like monthly income coming in. Like it may come bi-monthly or tri-monthly, or it may come half a year, or they might have this large sum. So they'll take their large asset, their large amount of money, and they'll divide it, and that's how they determine what the income is. You have your 1099 loans. The loan is self-explanatory. It's based on 1099s, where that's the opposite of your W-2s, where you don't pay any taxes up front. You don't pay Social Security. You don't pay Medicaid up front. They take that loans is just for that. Profit and loss is for those who have businesses that you have a CPA prepare your profit and loss statement. The profit and loss basically says the income that was generated for the quarter, which is the 3 months, versus the debt that was going out, and whatever's left over is what you have left. And so that has to be prepared by a CPA. This is something that you cannot do on your own. And then you have your foreign national loans. Foreign national loans are for those who are not citizens, who do not have social security numbers, but they have ITINs, which is their version of a social security number, and they pay typically a higher down payment, which is 30 to 40%, and they ask for a lot more reserves or money in their account because they're foreign nationals, they're not citizens. So at any moment, like God forbid something happens, they're like, oh my gosh, I don't want to be in the United States anymore. They decide to go back to Venezuela, or they decide to go back to Jamaica, they could just up and go. So they want to make sure that these folks have the funds to put down and also have the higher reserves in the event that I don't know, circumstances arise and they just want to make sure that they have their money. So again, non-QM loans typically require, I'm going to change that 10 to 25% down, plus 12 months of reserve. And a credit score, you can actually go as low as 620, but in my experience, they like for you to be like 660 and above. They are priced for risk, and you should expect origination fees of 1 to 2 points. When I say points, 1 point means 1% of the loan. 2 points means 2% of the loan. And some cases, the lender, that's the lender itself, not even the loan officer's compensation. That's what the lender will charge you for doing this loan because it's considered a risk. So let's go on to the next slide. So the next slide is DSCR loans. We just talked about DSCR loans. So I wanted to do a whole slide on this because this is a very common and trending type of loan. It's a very easy loan. It's a wonderful loan. It's a wonderful loan because this loan does not look at your debt. So let's say that you guys or ladies were in the weeds with credit card debt, car notes, like you had a great year and you bought yourself a G-Wagon. They don't look at that stuff. The only thing that the lender cares about is the rental income coming in on DSCR loans. So debt service coverage ratio loans represent one of the most significant innovations in investor lending in the last decade by qualifying the property's income. The property's income is the rent that comes in every single month rather than your personal income. So I did a DSCR cash out refinance for a gentleman who hasn't worked in years. I don't know when the last time he's had a job, but because he had rental income coming in and he had experience, and because he did investment, he was able to use the money from his investment to show his reserves, and he was able to use the rental income on that property to qualify to get a cash out refi. He's in his 60s, no, late 50s, and the gentleman has not had a job in years, and he was able to pull the equity out of that house to turn around and buy another house. Actually, he bought land, my bad. So this is how it works. As I had mentioned to you before, the ideal DSCR threshold is 1.25. So what that typically means is if your mortgage meaning your principal, interest, taxes, and insurance is $1,000, they want the rental income to be 1.25. So what that equates to is $1,250. So if they see that your rent is you getting rental income of $1,250, you're not gonna have any problems getting a loan right then and there. The only major factor left is if it appraises, but if they see that you're receiving more than your mortgage, that's a great sign. Most lenders will allow just one, meaning as long as your rent is 1,000, covering 1,000 of your mortgage, they're okay, but they really prefer this. So as I went ahead of myself, the minimum ratio is 1.0. Many lenders will allow that, but again, the sweet spot is 1.25. Now, the maximum ratio for the excuse me, loan to value for this is 75%, meaning that you would have to put 25% down. Some lenders will allow you to put 20%. Some will want you to put 25%. It really depends on the scenario. What would make you put 25% is your credit score. What will make you put 25% is if you are a first-time investor. Some lenders actually, if you're a first-time investor and a first-time home buyer, they would want you to put 30% down because you're new to this. You don't have any experience. But your credit score is what will make you put this amount of down. And if you're like in the high 700s, close to 800, some lenders will actually allow you to put 15% down. Now, when it says no limit, there's no caps on how many properties that you can finance. You can have 20 properties. These lenders do not care if you're doing this loan. You could like close on one property today And some lenders, not all, will allow you to do a cash out refinance on that property to take all that money out and then go ahead and buy another one. And this is why investors love this type of loan because you can have as many properties as you want, and then they don't even factor in your credit cards, or anything that's on your credit history or your income. So this is a great, great, great property to have. And then lenders are now starting to do short-term rentals with this product. And when I say short-term rentals, I'm talking about your Airbnbs and your Verbos. So those are great, great ways. And then foreign nationals like it because it's just going off of the rental income. They don't have to show any sort of documentation of how they make their money back home. So this is a great, wonderful product that you ladies should definitely, when you're ready, definitely get into if your if your credit history is a little bit high and your income is fluctuating, it's not the way you would like it. So now we're going to go to portfolio loans, banking relationships as capital. These type of relationships are with your credit unions and other entities. So portfolio loans are originated and retained by the lender. Some wholesale lenders are actually keeping their loans. So when they say that the loan is retained by the lender, wholesaling, think of wholesaling when you go, I don't know if any of you guys ever lived in downtown, I mean in Miami in the 80s and in the 90s, you used to be able to buy clothes wholesale, and you would like turn around and you would sell this bulk clothes for retail. You would mark the price up and you would sell it for retail price. That's exactly what wholesaling is. Lenders will give you a loan, and then they will turn around and they will sell the loan to someone else later on. I'm not sure if you ladies have ever bought a house and you notice that a couple months later you got a letter from a different lender saying, "Hey, I'm now the servicer of your loan." Has any of that happened to any of you ladies?
Yes,
Anybody?
yes,
Okay, perfect. So that's exactly what wholesale lending is, where portfolio lending, they actually keep the loan in their warehouse instead of selling it. And when they do keep it in their warehouse, they're a little bit more flexible. However, they might be a little bit more stringent because they have a lot of risk. There's a lot of risk of them keeping the loan. So they want to make sure that everything you say is yes. Your yes is your yes, your no is your no. You have to be very concise on whatever it is that you put on the loan application. So like I was saying, they allow flexible underwriting so portfolio lenders can consider the full picture of the borrower because they have a relationship with you already through your deposit accounts, and they see your overall financial health. Mortgages are amazing. Blanket mortgages is when you um, Blanket mortgages is when you buy, let's say, like 5 houses, and let's say that you bought these houses at a phenomenal price. You bought these houses at $50,000 each, 5 houses for $50,000, and the purchase price is going to be $250. Yeah, 250. So what the lender will do is they'll give you one single loan for all 5 of those properties. So instead of you having to pay all these different mortgages, you just have one. And I have a lender for that. So in the event that you guys are there, I have someone that will do a blanket mortgage. And with them, they only require a minimum 650 credit score to do that. And the minimum loan amount is 100,000. Some cases they'll make an exception, but if it's a blanket loan, it's your minimum loan amount is not going to be $75,000. It'll probably be like 100 or more. Entity lending, portfolio um, lenders are often only institutional source willing to lend directly to LLCs, partnerships, or S corps. So in the traditional loans that we talked about earlier, FHA, VA, and conventional, they require you to get the mortgage under your personal name, not an LLC. So these types of lenders will allow you to put your LLC under the loan loan's name, and that's the name that's going to go on title instead of your personal name. That is a feature that lenders like, I mean, investors like, because it protects anybody from going after them legally in the event like something happens and they try to sue them. So that's why lenders prefer to vest it in an LLC, or put the house or property under a company's name instead of their personal name. Relationship pricing: investors who main deposit accounts, operating accounts, or other banking relationships at institutions often receive rate discounts, kind of like credit unions, and faster approvals, because they already know what your relationship is like. They already know your financial health. They know your patterns. They'll know if you are safe to lend to, or if you are not safe at all to lend to. Um, the trade-off is with portfolio loan rates, they're typically a quarter to three-quarters the conventional above conventional, and the terms may balloon in 5 to 10 years. So you always want to have an exit strategy if you're going to do something like that. So let's go on to private lending and hard money. Speed as a strategy. So when people use hard money, they're in a hurry. They're not trying to wait 30 days to close on a loan. They're trying to do that in either 7 to 14 days. And usually with hard money, they typically need the properties usually tend to need some bit of repair. So we're going to go ahead and talk about that. With private and hard money lending, they occupy a high cost, but they have a very high speed, meaning again, they close in 7 to 14 days. These are asset-based loans underwritten primarily on the property's value and the deal's potential. They're not looking at your credit score. They don't care about your income documentation. They just want to know how much this property is worth and if the value is there. So you have to know what you're doing if you're going to do a hard money loan, because these loans don't usually last, they never last 30 years as the other three loans do. So your first type of financing is your fix and flips. That's if you find a distressed house. When I say distressed, the house needs a lot of love, meaning it needs some repair, and you need to fix it in order to flip it so you can make a profit out of it. So hard money is a dominating financing tool for these types of investors. The lenders underwrite based on an after repair value. So after repair, so they will take in consideration how much did it cost to repair this house. And you say, oh, I'm buying it for 50,000, but it's costing me another 50,000 to repair it. So they see that, okay, then the house is going to be worth $100,000. So if it's worth $100,000, they're going to give you 65 to 75% of that after repair value, covering the acquisition and a portion of the renovation costs. Again, the property will close in 7 to 14 days. You don't have to worry about 30 days to close, and then they're not looking at your income again. Now, the downside of it is your interest rates are 9 to 13%. There are some hard money lenders that are still doing 9%. I know a guy who's still at 9%, and he's actually pretty good. And he actually lends for condos. If you ladies ever are interested in investing in condos as rentals in the future. These type of loans, they typically will cost you 2 to 4 points, meaning 2 to 4% of the loan amount. That's what the hard money lender will charge you, and that doesn't factor in what the origination cost for the loan officer would be. So the terms are usually 6 to 18 months. Sometimes they'll go up to 24 months. Lately, I've been seeing 24 months, depending on the property. The speed is amazing. You guys can close in 7 days to 14, and the flexibility to move on to distressed properties is amazing. So this is a great idea if you are looking to fix and flip. Now you have private individual lenders. A lot of not accountants, not CPA, same people. There's a lot of attorneys that I have come across that they have a lot of capital, and they're always looking for some sort of deal. So these are like it says high net worth individuals, family offices, fellow investors that are looking to lend, and their terms are really negotiable because they're not doing these fix and flips. They actually look at quality properties. They actually will give you an amortization schedule. They will give you requirements on the collateral and their repayment structures. These are mostly, like I said, attorneys. They know what they're doing. They're structuring it, but you can still negotiate on these types of loans. How to find these people is if you like join a real estate club, they're usually there and you could like network with them and they'll tell you what their guidelines are to for them lending you money. Bridge loans are short-term financing instruments designed to span the gap between the acquisition and the permanent financing. So let's say that, you're trying to build something and you're short on funds. Bridge loans will help close that gap into building that building that property, or like if you're short on funds, the bridge loan will actually help cover or meet that gap in between the financing. The typical terms are 12 to 36 months. It's only interest only, you're not paying towards anything, and the interest rates are 7 to 12. Either they're adjustable or they're fixed. It really depends on the terms. Now we are going to co-buying and strategic partnerships. So, as I mentioned to you, some people buy in an LLC, some people purchase um, individually or by themselves. With real estate, it doesn't matter. You can do either way, whatever works for you. Co-buying arrangements and structured partnerships allow investors to pull in their money, their capital. So if you are short, it's nice to have someone else pull in their capital because you guys share the risk. You guys can complement each other on skill sets, and then you guys can access deals that would be out of reach individually because you didn't have enough funds to do it. So partnerships do work. It actually can accelerate your portfolio growth, and it can also create compounding advantages. Now, why should you partner up? Like I said, you're pooling your capital together. By combining your down payment resources, you're able to access larger and higher quality assets or properties, or simply close more deals simultaneously together. Your skill sets will complement one another. So one person might have the money, but another is good with finding the assets, finding the properties. The other person might be good at maintaining the property. Like if something goes, like let's say you guys have tenants, that person might be a contractor or has access to contractors, or the other person, that's not their forte. They just know how to find money and to fund them. So it's great to have a partner that you guys can share, or you ladies can share skill sets, or you guys can complement each other. The risk distribution. When you share ownership together, that means that you reduce the risk on any single asset. You guys share it together. The problem is not all on you. You have a partner that will share in the problems with you together. Like let's say that a property that you have, the roof needs to be replaced. You guys can share together on the cost instead of you having to replace that roof on your own. When you partner up, financing is a lot more accessible. So let's say that you guys end up buying a property together at a traditional financing. That person, you both can go on the loan together. Somebody might have a stronger W-2 and can qualify for conventional financing, where the other person has the capital, the reserves, the closing costs, the down payment. So one person complements each other. So if you decide that you want to venture off and do a partnership, all lenders, and if you're going to do it under an LLC, every lender asks for an operating agreement because they want to see what's the percentage of ownership. They want to see how is the capital distributed amongst each other. Is it 60, 40, 50, 50, 70, 30? They want to see those things. They want to know the decision making of authority. Who makes the decision when it comes to renovations? Is it just Tanisha? Does her partner Bev make the decisions on refinancing and selling it? And they want to know the cash flow distribution waterfall and preferred return structures. Who makes a decision on that? The buy sell provisions. Who decides how is it structured if you guys decide to buy and sell? What are the terms? Who has the right of refusal? Meaning, like, okay, I bring a property to Elma and we buy it together. And, Elma decides, I don't want this property anymore. You know, she has a right of refusal to exit if she no longer wants to be in it. And they want to know what the terms and the conditions are if she no longer wants to be on any property that we buy together. And they want to know how is the exit strategy structured. And then if the property is defaulted and there's a dispute, what are the resolution mechanisms? Do Miss Mary and I, we go through litigation together, mediation? What are they? So those are the typical things that the lender will want to know if you are buying under a partnership or an LLC. And these types of this really comes up not on your traditional loans. That usually comes up on non-QM loans, the non-traditional loans. They typically ask that when you're about to have the house and the loan under an LLC or corporation, that's really when they ask you that. You'll never see FHA or VA or conventional lender ask you for that. So just a note for you to know. Now we are going into buying in an LLC versus your personal name. What are the benefits of doing that? So one of the most debated decisions in real estate investing is whether to hold properties personally or through a limited liability corporation. So there's no really right or wrong answer. It's really what depends on you. It depends on the amount of investment properties that you have in your portfolio. It depends on your financing strategy. Are you planning on doing a DSCR loan where you're not showcasing or showing your credit history, your personal income? It depends on your tax situation because when you have these properties, you can file taxes on these properties. These properties are you get deductions. You get deductions when you file your properties. Anything that you pay for repairs, property maintenance, utilities, advertisement to rent that property out, you can claim all of that in your taxes. And then also your risk tolerance. So those are the things that you really need to think about before you purchase under your personal name or an LLC or limited liability corporate company. So if you buy in your personal name, you have access to traditional financing like FHA, VA, conventional loan programs. They have the lowest rates and they have the best terms. This is great if you're starting out because not everyone has the down payment to put 15% down, let alone 25% down. So this is a great entryway. And then later, you can always do a quick claim and quick claim from your personal name to Tanisha McClan LLC. So it's always good. Like if you're just starting out, this is a great way to start. And then the simplicity of it, fewer administrative requirements. So they're not going to ask you for an operating agreement. They're not going to ask you for your business tax returns. They're just going to only ask you for your W-2s. And some cases they might ask you for your tax returns. So this makes it a lot easier for you to close faster. The next thing is your liability exposure. Now, that was the thing I had told you. God forbid that you're exposed to lawsuits and you have a property under your name. This is now exposed. And so whoever's trying to, like you have a tenant that might have got injured because remember I said that we had a bad roof and it needed to be replaced. And part of the roof collapsed on your tenant while they were asleep. Now they're going to go ahead and file a lawsuit against you for damages and suffering. And because you have a property that's listed underneath your name, it now becomes exposed. So that's something that you definitely want to um, keep into consideration. So it's good for early stage investing, house hacking, and those prioritizing financing over legal protection. So again, like I said, you can always put it under your name first, and then later do a quick claim to Gabriella Andre LLC. Now, here's what the benefits are of buying in an LLC. You have liability protection. So in the event that your tenant, has a roof that fell on top of them while they were asleep, all these properties are under your LLC. And if you have it structured right, they won't be able to come after your property. Um, Financing limitations, most conventional lenders will not lend to an LLC. That is true on the traditional conventional lending. However, with your non-QM loans like DSCR, bank statement loans, profit and loss, they will lend to an LLC. The only thing is that you pay just a slight higher interest rate. You probably pay like one or 2% higher, and you can always refinance it at a lower interest rate. Your tax flexibility, LLCs can be taxed as sole proprietorships, partnerships, or S corps, offering significant structuring flexibility as income scales. So you guys can put all these properties under your taxes and get deductions from them, and then due on sale risk. So transferring a personal property title, transferring a personal title property into an LLC can trigger a due on clause in the mortgage, and that is something that you definitely would want to um, check before you do that, because if they see that, oh, you're selling the property to someone, they might see it as a sale when you're really transferring it to yourself, and they want the balance of the loan right then and right immediately. So that is something that you definitely need to look into whenever you're getting ready to purchase a property under an LLC. If I do the financing for you, which I'm hoping I will, that is something I will check if that is something with the lender. Would the lender cause that if you decide to transfer from your name to an LLC? So this is great for investors with 3 or more properties. You have a significant amount of assets to protect and access to non-agency financing. So many experienced investors use hybrid strategy, acquiring with conventional financing and personal name to maximize loan terms, meaning you guys are going to have lower interest rates, and meaning lower mortgage payments than transferring title to an LLC after closing. So again, if this is something that you want to do, you want to put it under Mary Manning Corp. You can do it, you can start off as, a conventional loan and then eventually transfer it to an LLC later. But you just want to make sure that if you do that you're not going to run the risk of the lender saying, oh, well, I want the balance in 30 days. So this is something that you want to, consult with a real estate attorney or a CPA, if you decide to go into that direction. Now, I wanted to talk to you ladies about credit optimization for investors. So, as we've been talking, credit is the gatekeeper to virtually every institutional program. Whether you're doing traditional financing or non-qualified financing, your credit score is the key that's going to get you whatever interest rate that's out there. So, if you have a credit score of 680 and above, you typically have really, pretty good interest rates, pretty good terms. 760 will give you the very best of the best. So here are some factors to look into that will drive your score. So 35% of it is your payment history. The single largest factor, even one 30-day late payment can drop your score significant from 50 to 100 points. So it's always important to automate all your minimum payments without exception. The one thing I want to say about your payment history, it's so important that you make your mortgage payments on time. because in the event that you see a property that you like, oh my God, you're crazy about, and you want to take the equity out of that house, and they see that you were late on your mortgage one time, that could literally destroy your chances of pulling out the equity from your home. There's somebody that I was trying to do a cash out DSCR loan for that person because they wanted to do repairs on their home, and they co-signed with someone else, and that person was late every single month. Every single month that person was late. The loan was bought by another lender and they were late with that lender too. So you really want to be very mindful of your mortgage payments to never be late, not even one time, because that can ruin your chances of pulling the equity out to purchase another property. Your credit utilization. For investors, they say that it's ideal to be at 10%, not just the commonly cited 30%. You guys are in your starting careers of an investor. So for now, stay at 30% and try to make your way down to 10% because that helps you a lot in having the optimal scores for low interest rates. The length of your history is extremely important. Even if you have credit cards that you don't even use that are old, that helps develop the health of your credit history, because even if you don't use them and you've had these credit cards for 20 years, that means you've had credit experience for 20 years. So you don't close out old cards that you do not use. Just keep them, pay something, just something small and pay it off just so you can keep the upward age. And then your credit mix is a combination of installment loans, which are your mortgages, your auto, and your revolving credit accounts like credit cards. You want to make sure that you're paying on time and you're keeping your credit utilization under 30%. And then as you guys gain more experience in investing, you want to bring it down to 10%. And then new inquiries. Try not to do too many because they do hit your credit score 5 to 10 points. And you don't want to do that while you're in the middle of a loan because what happens is when you're right about to close, they do run your credit again to make sure you still meet the requirement. And if you are doing a traditional loan, they run AUS. AUS is an automatic underwriting service where that lets the lender know that you are an ideal candidate for financing. If you do not pass AUS, you do not have a loan. You may lose your deposit depending on how the contract was written, and you lost a lot of time because you went and opened up a new credit card, or you bought or furniture or something. In the event that you are shy of the scores that you need to get a loan, you can always do a rapid rescore. A rapid rescore is um, someone like myself will work with the credit bureau and they will tell you the specific credit cards that needs to be paid off or you need to bring the balance to get you to the ideal scores that you need in order to get financing. They are a little pricey, but they work and they take 3 to 5 days. I would not do it before closing. I would do it before you get into the loan, because let's say you are under contract and you just need like, I don't know, 10 points, excuse me, just to get the financing that you need. It's always good to do it. Business credit separation, build a parallel business credit profile, your DUNS number, business credit card so that your business expenses don't affect your personal utilization ratio. So there are business credit cards that are completely separate from your personal credit history, like Truist and Wells Fargo, Chase. They offer business credit cards that will not affect your personal credit. However, even though they don't affect your personal, you still want to, don't neglect them. You still want to, pay them and always keep your balance low. Authorized user strategy. Let's say that you have a mini you that's in training to be an investor. If you want to boost their credit, and one of the greatest ways is to they don't have a card, but you add them to the credit card and you just help their scores to be to drive up. So they later too can purchase an investment or maybe even co-sign with you together on a loan. So that always helps. Pre-application review, you always want to pull all three of your credit reports to see where you're at before you're getting ready to purchase, so you know the landscape of your credit history, because it's better to know ahead of time than to be surprised when you are trying to get a loan. I pre-qualified a gentleman on Monday for a VA loan, and when I pulled his credit, oh boy, he had over $200,000 in student loan, and he had a lot of charge-offs and collections. And when I asked him, "Hey, Mr. Saul, what happened?" and he was like, "I didn't know I had all these things." And I'm like, in my mind, I'm like, you know, you had those things, but you want to make sure you want to know what your credit landscape is ahead of time and not when you're trying to get a loan, because at least when you do it 6 months before, you have time to figure out what the problems are. Pay down your debt, dispute any inaccuracies, so you have the time. So when you're about to apply for a new loan, you don't have these issues that come up, and you have a smooth closing. And then your score threshold matters. You remember 620 is a minimum. 620 is the minimum to get a loan. 660 is better for non-QM. 700 is the standard for conventional. 740 is best all around. Now with DSCR loans and non-QM lending, it's they really prefer 700. They really do. And when you have 700 and above, you actually have a lot better interest rates from up to a quarter of a point or a quarter of a percent. And what else? So this is your financing roadmap. Every successful real estate portfolio is built on a deliberate financing strategy, not a series of reactive loan decisions. So this is a financing roadmap that allows you to position yourself to figure out your target portfolio size and the specific financing tools, credit milestones, and capital relationships you need to build to connect each of these landmarks. So you'll see the foundation is your optimizing your credit, building your reserves, and establishing your banking. So when they say optimizing your credit, you want to keep your utilization down. You want to build your savings for your reserves to show that in the event that something happens to you, ladies, the bank knows that they're going to receive their payment every single month without failure. Establishing banking, meaning if you decide that you want to get a loan with a bank, like a credit union, you want to like open up an account and show, show that you're making faithful deposits. You're being reckless with NSFs, non-sufficient fund fees. Now, the next thing is your acquisition, trying to figure out, are you going to go the conventional route or are you going to do a DSCR loan? So your foundation will set the tone for your acquisition, scaling, using portfolio loans or private lending or entity structuring. So if you're using private lending, you're doing that because you're trying to do a fix and flip. And usually those who do fix and flips, they'll probably put the property under an entity name. And if you're doing any of your investments under an entity name, you want to look at whether or not you're doing it alone or are you partnering up with someone. If you are partnering up with someone, do you guys have an operating agreement that discusses every single person's role, resolution, conflict, risk mitigation, and who makes the decisions for refinances or renovations? And then optimization, where you're refinancing and repositioning your assets. Meaning, when you refinance, you're pulling the equity from your home so you can use that from not your home, but from a current you're pulling equity from one of your properties so you can reposition yourself to purchase another asset, and then you recycle that whole process over again. So this is your roadmap as an investor for your financing. Um, Things that you should ask yourself, ladies, um, when you're doing this, what is your hold strategy? Are you guys looking to fix and flip? That determines the course of which direction you're going to take in financing. Are you going to do a short-term rental? Are you doing an Airbnb? Are you doing a long-term rental that you actually having tenants stay in the property for 12 months or for 12 months or more? Or are you doing a value add? The next question is, does the property qualify for agency financing? Meaning, does it qualify for traditional financing? If it does, use it because your interest rates are going to be a lot lower, meaning your mortgage will be a lot lower. Does my income documentation support conventional underwriting? If it does, if it does, okay, if it does support your conventional financing, does support conventional underwriting, use it because again, you will have favorable interest rates. If it does not, then you can explore non-QM or DSCR loans. Remember, DSCR loans are loans that only go by the rental income only. It doesn't look at your credit history. You guys could be completely maxed out on your credit card. Just as long as you have that 620 credit score or 660, you can get financing for a DSCR loan, or you can explore all the other non-QM loans I told you about, which is bank statement, profit and loss, or asset depletion. Does the deal require speed or flexibility beyond what institutional lenders can provide? Then you might need to consider private or hard money. Now, again, if you want to find private lenders, specifically attorneys, you can find them at real estate investment clubs. They're there looking to find their next deal, or you can do hard money. Hard money will close anywhere from 7 to 14 days. They do have higher interest rates from 9% to 13%, but you close a lot faster. And lastly, can I optimize the structure with a partner, entity, or creative financing overlay? Meaning, can I structure this deal with a partner or with just another person on the loan who's going to share deed, or am I going to do it under an entity like an LLC or a corporation, or create a financing overlay, meaning that's just a fancy word for these first two. And so again, ladies, when you're building your lending network, you want to definitely get with a mortgage broker like myself, who has access to over 40 lenders that can match your profile. Because again, every scenario is not the same. They're all different. They're all everybody's scenario is different. One person may be 1099, the other person may be retired and sitting on a lot of cash and they don't know what to do with it. So every scenario is different. Banks, they are the ones that cultivate at least one portfolio lender relationship before you need it, meaning they will develop a relationship with you by looking at your deposits that you put in your account, and they see your financial health. And those types of relationships, they do work. And then you also have your private lenders that attend the real estate investment class. Hi, Miss Patricia. I am going to send you this recording after class because we are almost at the end. So you want to join investor meetups because that's where you'll find these private lenders that can give you that can help you with your trickier scenarios in the event that you don't want to use a hard money lender who has higher interest rates and a shorter amortization schedule. You definitely want to consult with a CPA or and a real estate attorney. So when you are structuring your LLC and you want to know your tax strategy for when you're filing taxes on these properties, everything is in the up and up, and the IRS doesn't come after you for misappropriation of monies when you sell your properties, and also a legal strategy to make sure that your legal entity is structurally sound. So in the event that something happens, no one can come after your assets. So these, again, you want to have your mortgage brokers, community banks, private lenders, CPA, and attorney team. And Just to recap what we talked about, successful real estate investors approach financing with intention and a clear strategy. Here are core principles to guide you through your journey. Your strategic debt use, you want to leverage financing as a precision tool to amplify your returns and manage risk effectively rather than viewing it as a burden. You want to match your financing to deals. You want to align your loans, conventional DSCR, portfolio hard money with specific deal characteristics and personal income profile. You want to be proactive in relationship building, cultivating strong banking and private lender connections well in advance to ensure capital is accessible when opportunities rise. Optimal ownership structure, strategically choosing your property ownership, whether it's an LLC versus personal, to align with liability protection and long-term portfolio goals. Credit mastery is a big one, guys or ladies. Excuse me, I have to stop saying that. Proactively manage and optimize your credit report to unlock the most favorable rates and gains to access a wider array of financing programs. So again, credit is the key to this whole thing, ladies. And then phased roadmap adherence. Follow a systematic, financing roadmap from foundation to acquisition to scaling and optimization for structured, sustainable expansion. And then lastly, integrated decision making. Ensure each of your financing decisions synergizes with and strengthens your overall investment strategy, avoiding future constraints and fostering continuous growth. So these are your strategies at a glance. Um, this is so important. And this is just the second class. I have so much more to teach you guys the next 2 weeks. So I'm gonna definitely send you this. I'm gonna send you this Zoom because this is so important in your journey because this is this is what's gonna help you to become an investor. This is what's gonna get you into the door. And then the next 2 days is what's gonna help you keep it in the family. So I want to thank you ladies for allowing me your time. You guys gave me an hour and 17 minutes of your time, and I truly appreciate it. I don't take that lightly. So we're meeting next week, Wednesday again, and we have another topic. What is my next topic for next week? I'm gonna tell you, and it's a good one too. Let me tell you what it is. Um, while I'm looking for that, does anybody have any questions? Any questions? Any?
Um, Actually, I did have some. Give me 1 second.
Okay.
And you can hear me okay?
Oh yeah, I can hear you just fine.
Okay. So I guess I had the house hacking, but I think I got the answer. That's like if you have 2 to 4 units, correct?
Mhm. Right.
That, that is okay. How do you, okay, when does the MIP gets removed? You said, does it come off automatically after you get to the 20% of your loan, or do you have to do something?
Okay, so MIP, okay, so you have
Uh-huh.
PMI and MIP. MIP is for FHA loans. And with
Right.
MIP, those stay for the life of the loan. If you put, that stays for the life of the loan if you put less than 10% down on an FHA loan. Now, if you pay more than 10%, then you don't pay MIP on FHA loans. Now, PMI is if you put, that's the same, but for conventional, if you put less than 20% down, you're gonna pay PMI. But as
Oh, so that one is strictly on the conventional loans.
right. So
Okay.
yeah, so once you hit the 20%
And then
threshold,
it drops off, right?
huh?
That's when it's gonna drop off.
Exactly. That's exactly it. That's when it's gonna drop off. It drops off right. Yeah,
Oh,
exactly.
okay.
Mm-hmm.
But the key, it has to be a conventional loan. Okay.
Right. Yeah.
No.
Another thing too, like if you end up you buy a property conventionally, and that's something that I don't know why I didn't tell you that, but if you buy a loan conventionally, um, and you decide that you want to, refinance it into an FHA loan because the interest rates are better, you can never go back to refinancing it as a conventional loan. If
Oh,
you refinance it again, it just stays as such.
okay, okay, I see.
Yeah.
One, one,
Um,
one more since they're
that's
giving me
fine.
the
That's fine. Go right ahead because I was just gonna cough.
okay. The bridge loan. Now, you said it's only interest only. So when do you get to pay off the loan?
So bridge loans are shorter loans. They only last
Right,
18 months. They're not 30-year fixes. So
right.
if you decide to pay it off early, it's kind of like hard money. They want you to pay it off early. So yeah, so you can pay it off as early as you can, but they don't last no more than 18 months.
Okay, I see.
Yeah. Any other questions?
Not right now. Thank-
Okay. Any other ladies have any questions?
Well, Kathleen, is Beverly. This
Hey.
would have been great for my brother because he's looking to get one of those fixer-upper, and
Oh,
he's a handyman. He
oh,
does home
okay.
improvement, but
Okay.
again, proving his income and all the other stuff that goes with it is his challenge. And for him to sit here and do this is going to be an issue. But I would love for him to hear this because he needs to know his path to getting
Okay.
this done.
No problem, no problem. I'll definitely share this recording with you guys.
Yeah.
And he can listen to it, I guess, at his own time. Does anybody else
Mhm.
have any other questions? No? Okay. So the next class will be on the 22nd at 7 p.m. This class is called Extracting Wealth Using Equity to Scale. Even though I've been talking about equity, I'm going to go a lot deeper into it. And this class starts at 7. So if you haven't registered for the 22nd or for the rest of the classes, if you liked, please, go ahead and register for the rest of the classes because they're really good and they're extremely detailed. One other thing that I wanted to share with you, ladies, is I'm hosting an event. No, I'm hosting an event in next month, and this one is completely free. This is just to let your hair down, have a good time, and this is like it's like a game night, but it's a happy hour. And so this is going to be at the Total Wine in Aventura. There's going to be refreshments, well, food and beverages and games and prizes. And this is not like what we just did. You get to just chill and play and network. And this is just like a home buying trivia. So I'm gonna send you guys this flyer and the link, and you guys can bring your friends. Again, this is completely free. This is at Total Wine. I'm gonna have food and beverages, um, adult beverages and non-adult beverages. So it's just a nice, fun way to just have a good time, kick back and relax. And it's just like a game night, but just with um, at Total Wine. So I hope you can make it. So again, the next class is on the 22nd at 7 p.m. What else? And I will send you guys the recording for this so you guys can listen to this because I know it was a lot of information. It was a lot. And it gets even better. So again, I want to thank you guys for giving me your time, lending me your ears, and I truly, truly appreciate you guys immensely. Does anybody have any final things to say before we go?
I
Anybody?
will just ask you to post it on the vacation social because I have a lot of people on there and this may be
Oh,
something they're interested in.
okay. Perfect. Thank you so much, Beverly. I appreciate that. Does anybody else have anything they want to say?
Nope, just thank you very much.
Okay.
Great job, great presentation.
Thank you so much. So I
Yeah,
Okay.
very informative and look forward to next week.
thank you so
Yeah.
much. I was a little bit worried because you didn't ask not one question, Tanisha. I was like, oh my gosh, she's not asking nothing.
Well, I was listening and then, I was thinking and thinking. So I'm going to go back and listen to the video again so that next week I might ask the questions. But one
Okay.
thing that raised my ear was the DSCR loan and the rental, because that's like really interesting. Instead of, to get, maybe that's an easier path on getting a loan for strictly rental property. And so I was just like, interesting. So my ears raised on that one. So I'm like, ooh, that sounds good.
It is. It's a really powerful tool. Like I'm telling you, like I have this, oh my God. Oh my gosh. I had this guy, man, another person, like his credit was so murky. Like, you know how water is supposed to be clear? His credit was murky. And he was able to get a loan because of a DSCR. I promise you, these loans are for real. The only thing is you do have to put more of a down payment, but hey, if you go in with somebody, two is better than one. Or if you're able to take money from even from your current equity, it works. Like this is a great, and then you don't even take long. You can close in like 14 to 21 days.
Wow.
Yes. So it's a
Wow.
great program. It's an amazing tool, man. And you can have as many properties with that type of loan. With conventional, you're only maxed at 10. Yeah. Oh, one thing I forgot to tell you, because a lot of you guys, ladies are new. At the end of all of this, I'm doing a investment tour. I actually read through some of the polls last week, and many of you guys wanted to just stay within Florida. So I'm gonna create an investment tour during the summer, and when we're done, I'm gonna reach out to each of you ladies, and I'm gonna tell you about it. And if this is something that you're interested in, this is something that we can do as a group, and you guys can actually see investment properties. You can actually see them and meet inspectors, title people, all your team that can help make your investment dream a reality. So I will definitely be in touch with you ladies sometime in May, late May, possibly early June about that.
Okay.
Okay?
All right. Awesome.
All
See y'all
right.
ladies next week.
Bye.
Bye. Meeting you all.
Okay.
Okay.
Bye.
Bye-bye. Bye,
Bye.
guys.
All right.